There's a certain kind of money conversation that always sounds a little bit like a secret. Someone leans in and says, the wealthy don't just use a normal super fund. They run their own. And suddenly, you're picturing control, freedom, property inside super, your money invested your way, no big institution taking a cut. It sounds like the grown-up version of superannuation, the version they don't advertise. And it's not a fringe idea anymore. More than 660,000 Australians now run a self-managed super fund. Together, they hold over $1 trillion, roughly a quarter of the entire national super pool. So this is not some tiny corner of the market. It's mainstream, and it's growing fast. But here's the boring question almost nobody asks first. At what balance does an SMSF actually make sense? Because if you get that number wrong, you haven't taken control of your super. You've just signed up to pay more and do more work for the privilege of holding the same investments you could have held anyway. So today, no hype, no fear, just the real threshold, the maths behind it, and a simple test you can run on yourself. Let's start by fixing the frame, because most people argue about the wrong thing. The SMSF debate usually gets framed as control versus convenience, or it turns into a fight about returns, whether SMSFs beat the big funds or not. Both of those miss the thing that actually decides it for you. And that thing is cost structure, not how much an SMSF costs, how it costs. Because the way the cost is built is the whole story. Here's the difference in one sentence. A big fund charges you a percentage of your balance. An SMSF charges you mostly in fixed dollars. Sit with that, because everything else follows from it. When you're in a large fund, your fee is a slice of whatever you hold. More balance, bigger slice. But an SMSF is different. The audit, the annual lodgement, the accounting, the levy, those cost roughly the same whether your fund holds $150,000 or $1.5 million. The bill barely moves. That one difference is the entire game. So let's actually price it, honestly. Take a simple fund. Listed investments, index funds, clean records, an online administrator. You're looking at administration and your tax return. Then the independent audit every fund is legally required to have, where the median fee is around $550. Then the tax office supervisory levy, $259. Then a small annual company fee to the corporate regulator, about $67. Added up, and a straightforward fund realistically runs somewhere between $2,000 and $3,500 a year. There's also a one-off setup cost, usually $1,500 to $3,500, to get the trust deed and the trustee company in place. Now, you'll see much scarier numbers quoted. Across the whole sector, the median operating cost is about $4,500, the median total cost closer to $10,000, and the average total cost around $17,500. But those big averages are dragged up by large, complicated funds. Funds that borrow to buy property, funds with insurance and paid investment management stacked on top. A plain fund holding index investments sits well below them. So don't let the average scare you. But don't kid yourself, the cheapest quote is the real cost either. The truth sits in between. Okay, fixed dollars. Now watch what that does as your balance changes, because this is where it clicks. Say your simple fund costs $3,000 a year, flat. On a balance of $50,000, $3,000 is 6% of everything you own. That is enormous. On $100,000, it's 3%. On $200,000, it's 1.5%. On $300,000, it's 1%. On $500,000, it's 0.6%. And on $1 million, that same $3,000 is just 0.3%. Same bill. The percentage keeps shrinking because the dollar figure isn't moving while your balance grows. Now hold that against a big fund. A typical large balanced option charges you roughly 1% all in every year, no matter how big you get. A really low cost one might be around 0.7%. So now the question sharpens into something you can actually answer. At what balance does your fixed SMSF bill drop below what a percentage fund would charge you? And that's just division. Take your fixed cost and divide it by the fund's fee rate. A lean fund running $2,000 a year against a big fund at 1% breaks even at $200,000. A typical simple fund at $3,000 breaks even at $300,000. If the big fund is cheaper, say 0.85%, or your SMSF is a bit dearer, the crossover drifts up toward $350,000, $450,000. So the honest answer was never a single magic number. It's a band. $200,000 at the floor and around $300,000 as the number most people should genuinely plan around. And here's the part I want you to trust, because you don't have to take my arithmetic on faith. The regulators and the researchers landed in almost exactly the same place, coming at it completely differently. Back in 2019, the corporate regulator put out a fact sheet that implied you needed around $500,000 to make an SMSF worthwhile. It got hammered by the industry because it leaned on those distorted averages from big, complex funds. Then the University of Adelaide studied more than 318,000 funds and found that SMSFs above $200,000 were genuinely competitive with the big funds on returns after costs. The actuarial firm Rice Warner ran the cost side and found the same $200,000 threshold. And in December 2022, the regulator withdrew that $500,000 line and now says balance is only one consideration of many. Different people, different methods, same landing zone. In personal finance, that's about as close to agreement as you'll ever get. But I promised you honesty, so here's the other edge of it. Below that band, the picture is genuinely worse, and not just on cost. That same research found funds under roughly $100,000 to $200,000 had materially weaker performance after fees. And the most recent Adelaide research, over the 5 years to June 2024, found SMSFs beat the big funds by around 1.1 percentage points a year on average. Sounds great. But it came with a much wider spread of outcomes. And that word, average, is hiding something. It hides the winners and the losers inside it. An SMSF does not come with a good return attached to it. It comes with a steering wheel. What happens next is on you. And as always, past performance, for any fund, self-managed or not, tells you nothing certain about the future. So picture the two versions of this person, because the balance is what flips the whole verdict. Version 1. You've got $80,000 in super. You set up a fund because a podcast made it sound clever. And now you're paying $3,000 a year, nearly 4% of your balance, to hold basically the same index funds you could have held inside a big fund for a tiny fraction of that. You didn't buy freedom. You bought paperwork and a worse outcome. Version 2. You've got $350,000 and you actually want to hold something a big fund won't let you. Direct shares chosen by you, a specific strategy, or down the track, your own business premises held inside super. Now that fixed cost is a rounding error against your balance, and the control is real, and it's earning its keep. Same structure, opposite answer. The only thing that changed was the size. So what do you actually do with all this? 4 steps. 1. Find your real number. Add up your super. And if you've got a partner who'd be in the fund with you, add theirs too, because a fund can have up to 6 members, and a couple pooling $180,000 each clears the band together, even if neither of them could alone. 2. Price the fund honestly, not from the brochure. Get a real, all-in annual quote. Administration, audit, levy, company fee, everything. And be a little suspicious of anything advertised as almost free, because the rock-bottom setups often mean no help at all when something goes wrong. And with super, something going wrong is expensive. 3. Run the one-line test. Take that honest annual cost and divide it by your balance. If the answer is above about 1%, an SMSF is probably costing you more than a good low-cost big fund would. If it's comfortably below 1%, now you're in business. 4. And this is the step everyone skips. Ask whether you even need one. If all you actually want is cheap, simple, diversified index exposure, a big low-cost fund already does that. Cheaper, and with none of the trustee obligations. An SMSF earns its place when you want something a big fund genuinely cannot give you, not when it just feels more sophisticated. And that word, trustee, is not decoration. Running an SMSF makes you legally responsible for that fund. The compliance, the annual audit, the investment strategy, the record keeping. That's not a fee you can pay someone to make disappear. It's your time and your accountability every single year. Quick and important. Everything in this video is general information, not personal advice. I don't know your balance, your tax situation, or your plans. And whether an SMSF suits you depends on all three. Before you set one up or wind one down, please speak with a licensed financial advisor and a good SMSF accountant. These decisions carry real tax consequences, and some of them are genuinely hard to reverse. But the headline is simple enough to carry around in your head. An SMSF is not a smarter version of super. It's a different cost structure, and it rewards size. Under about $200,000, it's usually the expensive way to do the simple thing. Around $300,000 and up, with a real reason to want the control, it starts to pay for itself. That's the whole threshold. If that made the maths finally click, do me a quick favor and hit the like button. It genuinely helps this channel reach the next person asking the same question. Subscribe if you want more plain English money videos with the boring parts left in, and I'll see you in the next one.